Welcome to the deep dive. The place where we try to help you guys understand some of those complex topics that you're interested in, but you don't really have the time to spend hours digging into all the research. And, you all sent us in some really interesting research recently about predicting the stock market. So we've been going through it, and we've got some fascinating insights to share with you today.
Absolutely. We're going to be taking a look at some really cutting-edge research on predicting where the market is heading.
Exactly. And you know what's really cool about this particular set of research is that it's taking a totally different approach than what we traditionally think of when we talk about stock market prediction.
Mm.
It's not just about analyzing, charts and historical data. It's actually bringing in some, almost human-like understanding of the market, like reading the news and understanding the sentiment around different stocks.
That's right. This research really gets at that core problem. Traditional models often miss the bigger picture, all those real-world events that can completely shake things up and send prices soaring or plummeting.
Exactly. We've all been there, right? You think you have a good grasp on a particular stock, you're feeling confident, and then boom, some major news drops and everything changes.
Precisely. And that's the gap this research is trying to bridge. Traditional models are great at crunching numbers and spotting trends in the data, but they often work in isolation. So they kind of miss those crucial clues that come from outside the numbers, from things like news articles, social media chatter, financial reports, the kind of information that reflects the real-world narrative around a stock.
Totally. So our mission today is to dive deep into this new approach and see how combining those different pieces of the puzzle, past stock performance, geographical factors, and all that text data can actually give us a more holistic and hopefully more accurate picture of where the market might be headed. And I gotta say, there are some pretty surprising findings in this research.
Oh yeah, some real eye-openers. And the heart of this new method is this really interesting model called a two-level conv-LSTM neural network integrated with a large language model, which I know sounds super technical.
Yeah, it does, yeah.
But don't worry, we're going to break it down step by step and explain what each piece does and how it all works together.
That's right. We're going to unpack this in a way that hopefully makes sense, even if you're not, a data scientist. So let's start with the basics. Why is predicting the stock market such a notoriously difficult thing to do in the first place?
Well, I think anyone who's even glanced at a stock chart can tell you that the market very rarely moves in a nice, predictable straight line. It's a really complex system that's constantly influenced by a huge number of factors, macroeconomic trends, company-specific news, investor sentiment, geopolitical events, you name it.
Yeah, all those things.
All these things interact in really complex and often unpredictable ways.
Yeah.
So the fundamental challenge is trying to identify and anticipate these patterns.
Makes sense. So when people have tried to build models for this in the past, they've often leaned on things like CNNs and LSTMs. Can you give us a quick, non-technical overview of what those are and how this new approach is different?
Sure. So you've got convolutional neural networks, or CNNs. These are really good at recognizing patterns in data that has a kind of spatial structure. So think of it like picking out the key features in an image. In the world of finance, this might be looking at the relationships between different pieces of stock information all at the same point in time. And then there are long short-term memory networks, or LSTMs, and these are designed to handle data that changes over time, like sequences of information. They're good at spotting trends in historical stock prices, for example. And what's really cool about this new approach is that it doesn't just choose one or the other, it actually uses both CNNs and LSTMs, and it adds this whole other layer of understanding on top of that.
Right. And that extra layer comes from looking at different types of data, right? Like the research really digs into spatial data, temporal data, then this combination of spatiotemporal data, and finally textual data. Let's break those down one by one. So first up, what exactly do we mean by spatial data when we're talking about the stock market? It's not something you hear every day.
Right. Spatial data, in this context, refers to all those geographical factors that can actually have a pretty big impact on how the market behaves. This includes things like where trading activity is concentrated, where investors are located, and importantly, the effects of regional economies and regulations. So for example, knowing the trading volumes in different financial hubs around the world can give you a sense of where the most significant action is happening, or even thinking about political stability or regulatory changes in a particular region where a company does a lot of business. That can be really important for understanding investment risk. It's really about understanding the impact of location.
Gotcha. So it's not just about the company itself, but also the wider geographical context it's operating in and where all the money's flowing around the world. Makes sense. Now, what about temporal data? That sounds a bit more like the traditional stuff we think about when we're talking about the stock market.
Exactly. Temporal data is all about how things change over time. So in the stock market, this mostly means tracking things like stock prices, trading volumes, and all those other market indicators as they change from day to day, week to week, year to year. So it's the classic idea of analyzing data as a time series. Investors use this to spot trends, try to predict where prices might go next, understand how events in the past have impacted the market and things like that. And volatility analysis, that's a key part of analyzing temporal data. It's looking at how much prices fluctuate over time, basically how bumpy the ride is. It's all about understanding the timeline of events.
Right, looking for patterns in those ups and downs, trying to make sense of those peaks and valleys. Got it. And then we have spatiotemporal data, which, if I'm understanding this correctly, is basically bringing those first two concepts together. How does that give us an even richer understanding of the market?
Precisely. Spatiotemporal data takes both those geographical factors and looks at how they change over time. It's about seeing how different regional markets react to global events, political shifts, economic policies, and importantly, how these responses might differ across different regions and at different times. Like, for example, a political event in one part of the world might immediately hurt stock prices in that specific region, but the ripple effects and how quickly things recover, that could be completely different in other parts of the world. So this combined view, the spatial and the temporal together, that gives us a much more complete picture of how the market actually behaves. And this is where those conv-LSTM models come in. They're really well suited for analyzing this kind of data.
Ah, the conv-LSTMs. So how do they actually help us analyze this combined spatiotemporal data?
Well, conv-LSTMs are specifically designed to handle both the where and the when, those spatial and temporal factors. They combine the power of convolutional layers, which are really good at finding patterns in data that has a structure, like the relationships between different geographical regions or different stock features. And they blend that with the strengths of LSTM layers, which are amazing at understanding how things change over time, picking up those trends and movements. So to give you a concrete example, a conv-LSTM can look at how trading activity in different parts of the world, different financial centers, changes over time in response to, say, a big economic announcement or a geopolitical event. And that gives us a much more detailed and nuanced understanding than just looking at the data from a single region or a single point in time.
Okay, that makes sense. It's like the convolutional part is looking for those interesting spatial patterns and then feeding that information to the LSTM part, which then figures out how those patterns change over time. Now, the real innovation here, the thing that really sets this research apart, seems to be this idea of bringing in textual data and these large language models. How do they fit into this whole picture?
This is where things get really fascinating. So large language models, or LLMs, are these powerful AI systems that are incredibly good at understanding and processing human language. They can read and analyze massive amounts of text from sources like, financial news websites, social media platforms, company reports, all sorts of stuff. What they bring to the table is this ability to extract meaning from all that text, to understand the sentiment, the kind of feeling or tone behind the words. So are people feeling optimistic, pessimistic, or neutral? And they can also figure out how strongly those feelings are being expressed. This is huge because it adds this crucial layer of context to all those numbers we've been talking about. A stock price doesn't just exist in a vacuum. It's constantly being influenced by the stories and opinions that surround it, and LLMs can tap into that.
Yeah, that makes total sense. It's like adding the human element, the emotional side of the market into the equation.
Exactly. Like, for example, an LLM can read through a bunch of news articles about a company and figure out if the overall sentiment is positive, negative, or somewhere in between. And it can even gauge the intensity of that sentiment. Like, is it mildly positive or is it super bullish? That gives us a much richer understanding of the market conditions because we're not just looking at the numbers, we're also taking into account the narratives that are shaping how people feel about a stock.
That's really cool. So let's dig a little deeper into the first level of this model, those conv-LSTMs we talked about. You mentioned that they combine CNNs and LSTMs. Can you tell us a bit more about how they actually handle those changes over time, how they learn from that temporal data?
Sure. So LSTMs, those long short-term memory networks, are a type of neural network specifically designed to process sequences of data. What sets them apart is this really interesting internal structure that allows them to remember information over longer periods of time. It's like they have a built-in memory system that helps them keep track of important trends. And this is really useful when you're trying to understand how stock prices move up and down over time because, the price today might be influenced by something that happened weeks, or even months ago. Unlike simpler models that might kind of forget that older information as they process new data, LSTMs can hold on to those long-term patterns. And the way they manage this memory is through these things called gates, which control what information gets stored and what gets forgotten as the network learns.
Okay, so these gates are basically the key to that memory. What do these gates actually do?
Well, think of them like filters or regulators that decide what information is important and what's not. So you've got one gate that looks back at the past and decides what information is still relevant, what should be kept in memory. Another gate looks at all the new information coming in and decides what's important enough to be added to memory, what deserves to be remembered. And then there's another gate that controls what information from that memory actually gets used to make predictions. They all work together to help the LSTM learn those long-term patterns in the data.
That's super clever. It's like the LSTM is constantly updating its memory, keeping the important stuff, and letting go of the irrelevant bits as it learns. Now, how do those convolutional layers we talked about earlier fit in with the LSTMs? How do they work together in a conv-LS LSTM?
So typically in a conv-LSTM, those convolutional layers actually do their work first before the information gets passed on to the LSTM part. And what they're really good at is spotting patterns in data that has a structure. In our case, that structure might be the relationships between different stock features, or if we're using geographical data, the relationships between different regions. And by identifying these key features, the convolutional layers are essentially giving the LSTM a more focused, more meaningful set of information to work with as it tries to figure out how those features are changing over time.
It's like they're working in a team. The CNN is doing the prep work, finding those important patterns, and then the LSTM takes over and figures out how those patterns evolve over time. Cool. Now let's jump over to the second part of the model, these large language models, the LLMs. You gave us a high-level overview, but can we get a little more technical? How do they actually understand language? You mentioned something called a transformer architecture.
Yeah, so most of the really powerful LLMs these days, like the one that you used in this research, Bert, are based on this thing called a transformer architecture. And one of the key innovations in transformers is this mechanism called self-attention, which is a bit of a mouthful, but it's basically a way for the model to figure out which words are the most important for understanding the meaning of other words within a sentence or a paragraph or even a whole article. Instead of processing the text in a strict sequence word by word, it can look at all the words at once and understand how they relate to each other.
So it's not just reading left to right, it's getting the context of the whole thing, like a human would.
Exactly. And this allows it to pick up on much more subtle meanings and understand connections between words that might be really far apart in the text. And these transformer models are made up of multiple layers of these self-attention mechanisms, along with some other components that help it process and understand language in a really sophisticated way.
Amazing. And the paper also mentioned a general process or workflow for how these LLMs work. Can you quickly walk us through the key steps involved?
Sure. So the first step is you need a ton of data. LLMs are trained on massive amounts of text data, often scraped from the internet. And this data then gets broken down into smaller pieces called tokens, which are usually individual words or parts of words. And then the model goes through this phase called pre-training, where it essentially learns the basic rules and patterns of language by trying to predict missing words or the next word in a sequence. It's kind of like filling in the blanks, and this helps the model develop a broad understanding of how language works. And then, of course, the core of the model is that transformer architecture with those self-attention mechanisms we talked about. But the cool thing is, once the model has gone through this initial training, it can be fine-tuned for specific tasks. So in our case, we want it to be really good at understanding the sentiment of financial news. So we would fine-tune it on examples of news articles and their associated sentiment, like positive, negative, or neutral. And then once it's trained, it can take new text and do things like classify its sentiment, generate text, translate languages, and all sorts of cool stuff.
So basically, it goes from being a general language whiz to being a specialist in a particular area, like understanding how the market is feeling based on the news. So now let's bring it back to the big picture, why this whole combined approach is so powerful for predicting the market. We talked about how traditional forecasting models often focus on just that temporal data, those historical trends. What's the crucial piece that's often missing in those traditional approaches?
Well, as we've been discussing, the big thing that's missing is that sentiment, the emotional context that's coming from the news and all that textual information. While models that just look at historical prices can be pretty good at recognizing patterns and trends, they often miss those sudden shifts in market sentiment that are driven by news events.
Mhm.
Like, you could have a stock that's been steadily climbing for months, but then a single negative report from a really influential source could cause its price to drop significantly, regardless of its past performance, and traditional models would struggle to predict that.
Right. So basically, if you're only looking at the numbers, you might be blindsided by those unexpected drops or surges that are driven by the news.
Exactly. And those sudden shifts can have a huge impact on your portfolio if you're not prepared for them.
Yeah.
So to really get those accurate predictions, especially when it comes to predicting those more unexpected market movements, we need to incorporate that external information, those real-world narratives that are shaping how people feel about a stock.
Totally. So that brings us to this proposed hybrid solution, this two-part model that combines the conv-LSTM with the LLM. Can you walk us through how these two parts actually work together?
Sure. So the first part involves that conv-LSTM network that we talked about earlier. And its main job is to make an initial prediction of the stock price based purely on the historical performance data, like the prices and trading volumes from the past. Think of it as establishing a baseline of where the stock might be heading based on those historical trends. But at the same time, there's a separate process running that's gathering all the news articles related to that specific stock over a certain period of time. This could be, articles from major financial news outlets, blog posts, social media posts, all sorts of things. And this news data then gets fed into a pre-trained large language model, like BERT, for sentiment analysis. The LLM reads through each article and assigns it a sentiment score based on the language used, typically on a scale that goes from, say, very negative to very positive.
Okay, so we've got one part of the model, crunching numbers, making predictions based on the past, and another part, reading the news and gauging how people are feeling. How do those two streams of information come together?
Right, so the second part of the model is all about merging those two streams. The predictions from the conv-LSTM, which are basically a series of predicted prices over time, get combined with those sentiment scores that we calculated from the news, which are also a series of scores over time. And this merging process, they call it time mapping, is basically about lining up those two sets of data based on when they occur. So for every point in time, we now have a predicted price from the conv-LSTM and a corresponding sentiment score from the news analysis. And now we've got this really interesting data set that combines both those forecasts based on historical data and the overall sentiment surrounding the stock at different points in time.
So it's not just about how the stock has been performing, but also how people are talking about it, what the mood is. That's really neat. And what happens with this combined data set?
So this combined data set, that's what we use to train another LLM, usually a transformer model. And this model learns to take both the initial prediction from the conv-LSTM and the current market sentiment as input, and then it tries to predict the actual stock price. It's basically learning how that sentiment modifies that initial forecast based on past data to arrive at a more accurate picture of what actually happened in the market.
So the LLM is basically learning to read the room to see how the market's mood is influencing the stock price on top of those historical trends. That's super cool. Now, can we get a little more granular here? How does the model actually work in practice? You mentioned some things like normalization and choosing the optimal length of historical data for the conv-LSTM. Why are those steps important?
Yeah, so data preparation is super important in any machine learning project, and that includes this one. So normalization, which they did using a method called z-score, is basically about making sure all the different types of data we're feeding into the model, like the stock price and the trading volume, are on a similar scale. This is important because if one type of data has much larger numbers than another, it can kind of unfairly influence the learning process. Normalization helps to level the playing field.
It's like making sure everyone has an equal voice, regardless of how loud they're speaking. What about choosing that optimal length of historical data to look at? Why is that important?
Right, so when you're dealing with data that changes over time, like stock prices, you have to decide how far back in time you want to look to make a prediction about the future. And this is what we mean by the length of the data sequence. And getting this right is crucial. If you look at too short a period, you might miss those longer-term trends. But if you look at too long a period, it becomes really computationally expensive to process all that data. Plus, the model might get distracted by older information that's not so relevant anymore. So it's a bit of a balancing act.
And how did the researchers in this study go about finding that sweet spot, that optimal length?
They most likely tested different sequence lengths and then measured how well the model performed with each one. And by gradually adjusting the length and seeing how it impacted the results, they would have been able to zero in on the length that gave them the best performance. It's a bit like trying different size windows to see which one gives you the clearest view of the landscape.
Makes sense. And once they found that optimal length, how did they actually create the training data for the conv-LSTM?
Well, they probably used a sliding window approach, where they take a chunk of historical data that's that optimal length, feed that into the model as one training example, and then slide that window forward in time by a small step to create the next training example. And they just keep doing this, sliding that window along to generate lots of different training examples. And by doing that, they cover different periods of historical data, which helps the model learn more robustly and capture those time-based patterns more effectively.
So it's about exposing the model to a wide variety of examples from the past. Now, we've talked about the data that goes into the conv-LSTM. What about how it actually learns from that data? The research mentioned something called a loss function. Can you explain what that is?
Yeah, so in simple terms, a loss function is basically how the model measures how far off its predictions are from the actual real-world values. Think of it like a way of scoring how well the model is doing during the training process. And the goal of the training is to minimize that loss, meaning we want the model's predictions to be as close as possible to the real data. And there are different ways to calculate that loss, different types of loss functions. And choosing the right one sometimes depends on the specific problem you're trying to solve and the nature of the data you're working with.
Gotcha. So it's the yardstick the model uses to measure its own performance and try to get better. Now, let's shift our focus over to how the news data gets processed. You mentioned they use an API to gather that data, and then there's some processing involved. Can you walk us through the key steps there?
Yeah, so they start by using an API, which is basically a tool that allows them to automatically pull in all the relevant news articles from a bunch of different sources. It's much more efficient than, manually searching and copying articles. This tool gives them the data in a nice structured format, which makes it easier to process. So they then process that data to pull out the important parts, which is the name of the news source, the title of the article, and the main body of the article, the text itself. And then comes tokenization, which is a crucial step for preparing the data for those large language models. Tokenization is basically about breaking down the text into smaller units that the models can understand. Usually these units are individual words or parts of words.
It's like translating the text into a language that the models can read. Now, once you have that tokenized news data, how does BERT actually analyze it and determine if a news article is positive, negative, or neutral? How does that sentiment analysis work?
So BERT, remember, is a pre-trained language model, which means it's already learned a lot about how language works from being trained on a massive data set of text. And it uses this knowledge to figure out the context of words and sentences. So when you feed it that tokenized news data, it can identify words and phrases that are typically associated with positive or negative opinions, and then it uses all that information to give an overall sentiment score for the entire article. It's like it's reading the article and getting a sense of the overall vibe.
Right. It's not just looking for individual words, it's understanding the whole message. So BERT gives us a sentiment score for each article, but what happens when there are, dozens or even hundreds of articles about a particular stock in a single day? How do they combine all those individual scores into a single measure of sentiment for a given day or a given week?
That's a great question. So they do this clever thing where they don't just treat all news sources equally. They actually weight the sentiment scores based on how influential they think a particular news source is. So, for example, a headline from the Wall Street Journal might carry more weight than a random blog post. And then they calculate some kind of average of those weighted scores over a particular time period, maybe a day, a week, or whatever makes sense for their analysis. So it's like taking a poll of the news, but some voices get more votes than others, depending on their credibility and influence.
So it's not just about the quantity of positive or negative news, but also the quality of those sources. That's really smart. Now we've got these two separate streams of information, the conv-LSTM giving us predictions based on past performance, and this overall sentiment score based on the news. How do they bring those two things together? You mentioned something called time mapping before.
Right, so time mapping is all about aligning those two data sets based on when they occurred. So the predictions from the conv-LSTM are basically a time series of predicted stock prices, and the sentiment scores are also a time series. We just need to make sure they're lined up correctly. So for every point in time, we've got a predicted price from the conv-LSTM and a matching sentiment score from the news analysis. And sometimes the news data might not perfectly cover the same time period as the historical stock data, so they might have to do some adjustments to make sure both data sets are aligned.
So they're essentially creating pairs of data points. For each point in time, we have the model's prediction based on the past, and we have the market sentiment at that time. And this is what gets fed into that final transformer model for the fine-tuning, right? How does that final training step work?
Exactly. These combined data, the predictions plus the sentiment, that becomes the training material for that final transformer model. And the model learns to take both of those inputs, the initial prediction and the sentiment, and then predict the actual stock price. And by training on a lot of these examples, it starts to understand how that sentiment information modifies that initial forecast, hopefully leading to more accurate predictions, especially when it comes to those sudden jumps or dips that traditional models might miss.
It's like the model is learning to combine those two perspectives, the cold, hard data from the past and the emotional, sometimes irrational side of the market as reflected in the news. And after all of this, how do we know if this whole fancy approach actually leads to better predictions? What did the results tell us?
Well, the real test is to see how the model performs on data it's never seen before. So they take a separate set of historical data in news, run it through the entire process, get predictions, and then compare those predictions to what the stock prices actually were. And they use a variety of metrics to measure the accuracy of those predictions, basically calculating how far off the model was on average.
And the research actually gave us some concrete results, right? They tested this on a couple of specific stocks, Apple and Google. What did those results show?
Yes, they did.
Yeah.
And for Apple, the results were really promising. The hybrid model, the one that uses both the conv-LSTM and the LLM, significantly outperformed the model that only used the conv-LSTM on its own. All the different error metrics they used showed a big improvement in accuracy when they added that sentiment data from the news. It's a pretty clear indication that incorporating that real-world information makes a big difference.
That's awesome. It really validates that idea that understanding the market narrative, how people are feeling about a stock, is just as important as understanding its past performance. And what about Google? Did they see similar results?
Absolutely. The results for Google were very consistent with the Apple results. Once again, the hybrid model, the one that incorporated the news sentiment, outperformed the model that just used the historical data. And again, they saw noticeable reductions in all the error metrics they looked at. So it's more evidence that taking those external factors into account leads to more accurate predictions.
So it seems like there's some real power in this approach. And beyond just predicting stock prices, do you think this type of approach, this idea of combining data analysis with the understanding of language and sentiment, could be applied in other areas as well?
Definitely. And actually, the research touches on some potential applications in other fields, like in healthcare. Imagine combining a patient's medical history with information from the latest medical research and news articles to get a better understanding of their potential outcomes. Or in supply chain management, you could combine data on inventory levels with news about things like geopolitical events, economic trends, or even weather patterns to make more informed predictions about supply and demand. There's a lot of potential here.
It's like adding that layer of human understanding on top of the raw data. That's really exciting stuff. Well, this has been an incredible deep dive. I've learned so much about this new approach to stock market prediction. The big takeaway for me is that integrating those different types of data, especially adding that textual sentiment analysis on top of the traditional number crunching, can really give us a much more robust and accurate way to understand and maybe even predict those complex systems like the stock market.
Absolutely. It's about looking at the full picture, not just a narrow slice of it.
Exactly. And hopefully this is giving you, our listeners, some of those aha moments that we were talking about without feeling completely overwhelmed by the technical details. So as we wrap up here, I want to leave you with something to think about. We've seen how effective it can be to incorporate news sentiment into these prediction models, but what other unconventional data sources might be out there that could hold valuable clues about the future, not just in finance, but in other areas of life, like could things like social media trends, online search patterns, or even changes in the way people are talking online give us insights into what's coming next? It's definitely something to ponder.
Absolutely. There's a whole world of data out there that we're just beginning to tap into. And who knows what amazing insights we might uncover by combining these different pieces of the puzzle in new and creative ways.
Definitely. So keep those questions coming. Keep sending us your interesting research. We're always excited to dive deep into these fascinating topics with you. Thanks for joining us for another deep dive.
Thanks for having me. It's been a pleasure.
And until next time, keep exploring, keep learning, and keep diving deep.